The trading floor is quiet, not silent, never silent, but the usual hum has thinned. A few analysts lean into their screens, scrolling through data that refuses to align with yesterday's models. Outside, the sky over lower Manhattan holds that pale winter light that makes glass towers look brittle. Someone's phone vibrates. No one picks it up. The numbers on the Treasury dashboard have shifted again, and no one wants to be the first to say it out loud. In this scenario, something unprecedented begins to unfold, not with a headline, not with an announcement, but with a pattern buried in overnight settlement data. The People's Bank of China has begun moving US Treasury securities. Not dumping, not crashing. Moving. $500 billion worth over 60 days. The kind of volume that doesn't scream. It whispers through every layer of the global financial system until the whisper becomes a pressure no one can ignore. Day one looks like nothing. A routine sale, $10 billion in 10-year notes. Markets absorb it without flinching. The Federal Reserve's primary dealers step in, as they always do, smoothing the transaction into the flow of daily Treasury operations. No alerts, no volatility. The system is designed for this, but the sales continue. Day two, another tranche. Day three, again. By day 7, the cumulative volume begins to register in the analytics software used by sovereign debt desks. A rhythm is forming, and rhythms in bond markets are either reassuring or alarming depending on what they replace. The first response comes not from governments, but from algorithms. High-frequency trading models detect the increased supply and adjust their pricing assumptions in microseconds. Treasury yields, those invisible benchmarks that govern the cost of borrowing across the entire American economy, begin to inch upward. Not sharply, a few basis points, enough to tilt the scale, enough to make mortgage-backed securities reprice, enough to change the math on corporate refinancing. By day 12, the movement is no longer invisible. Bloomberg terminals flash updates. Reuters runs a brief noting unusual activity in the Treasury market. The language is careful. Elevated selling pressure. Rebalancing of foreign reserves. No one uses the word China yet, but trading desks know. They always know before the headlines catch up. The question isn't whether China is selling, it's why, and whether this is the beginning or the middle of something longer. Here's where the mechanics matter. The United States Treasury market is the deepest, most liquid financial market on Earth. It absorbs shocks that would shatter smaller systems. But liquidity is not infinite. It's a function of willing buyers, available capital, and confidence in future value. When a holder as large as China, historically one of the top 3 foreign owners of U.S. debt, begins sustained selling, the market doesn't collapse. It adjusts. An adjustment at this scale means repricing risk across trillions of dollars in connected assets. The Federal Reserve faces a choice it hoped to avoid. Interest rates have been carefully managed for years, balanced between inflation control and economic growth. Now, as Treasury yields rise due to increased supply, the Fed must decide whether to intervene. Purchasing Treasuries to stabilize prices would expand the Fed's balance sheet again, undoing years of quantitative tightening. Not intervening risks a sharper yield spike, which would cascade into higher borrowing costs across the economy. Both options carry consequences no model can fully predict. By day 18, the yield on the 10-year Treasury note has climbed 30 basis points. It sounds technical, it sounds small, but that movement represents a fundamental shift in the cost of money. Mortgage rates, which track Treasury yields closely, begin to rise. A homebuyer in Austin, who locked in a rate last month, watches the same loan cost $200 more per month today. Multiply that across millions of households either buying, refinancing, or evaluating whether to move, and the housing market begins to cool in real time. But something else was shifting quietly. Corporate debt markets, which rely on stable Treasury benchmarks to price risk, begin to reprice as well. Companies preparing to issue bonds face higher interest costs. A manufacturing firm in Ohio planning a $100 million expansion recalculates. The project still makes sense, but the margin has thinned. Some companies delay, some cancel. The decisions are rational, isolated, invisible to the public. But in aggregate, they represent a slowdown in capital deployment. Investment decisions deferred, hiring plans postponed. The gears of economic growth don't stop, they hesitate. Currency markets react with their own logic. As Treasury yields rise, the dollar strengthens. Higher yields attract global capital seeking safer returns. Investors in Europe, Japan, and emerging markets shift portfolios toward U.S. assets, increasing demand for dollars. This sounds stabilizing, and in some ways it is. But a stronger dollar makes American exports more expensive. A factory in South Carolina exporting machinery to Brazil finds its products less competitive overnight. Orders slow. The feedback loops begin to multiply, each rational response creating a new pressure elsewhere. By day 25, financial media has caught up. Headlines appear. China reduces U.S. Treasury holdings. Bond market volatility rises amid foreign selling. The language remains measured, but the tone has shifted. Analysts appear on cable news explaining yield curves and reserve diversification. Most viewers don't follow the technical details, but they absorb the mood. Something is changing in the architecture of how money works. The first signs weren't obvious. Pension funds, which hold enormous quantities of treasury bonds as safe, long-term assets, begin to see paper losses. The bonds themselves haven't defaulted. They never will, barring an unthinkable collapse in U.S. creditworthiness. But their market value has declined as yields rose. Funds that need to meet near-term obligations face a quiet dilemma. Sell at a loss or hold and wait for maturity. Neither choice is catastrophic, but both constrain liquidity. Retirees don't see this directly. They see statements arrive with values slightly lower than expected. Confidence, that intangible foundation of financial systems, begins to erode at the edges. By day 33, the scenario reaches its midpoint. China has sold roughly half the intended volume. $250 billion have moved out of US Treasuries and into a combination of gold, other currencies, and regional infrastructure bonds. The sales have been orderly, no panic, no emergency sessions. But the market has adapted to a new reality. The largest foreign holder of American debt is no longer accumulating. It's divesting, and markets price the future, not the past. The data looked stable until the second layer appeared. Municipal bonds, the instruments cities and states use to fund infrastructure, rely on spreads above Treasury yields. As those yields rise, municipalities must offer higher rates to attract investors. A city in Michigan planning to issue bonds for a water system upgrade faces higher costs. The project moves forward, but the debt service will consume more of the annual budget, fewer resources for other needs. The choices are incremental, technical, invisible to most residents, but they compound across thousands of jurisdictions. Financial institutions begin adjusting their balance sheets. Banks hold treasuries as high-quality liquid assets, required by regulation to cushion against crises. As yields rise and prices fall, some banks face mark-to-market losses on their holdings. No bank fails, no runs occur. But the calculus of lending tightens. A small business in Nevada applying for a loan finds approval slower, terms stricter. The connection between China's bond sales and a delayed expansion of a local bakery is invisible, indirect, but real. By day 40, the geopolitical interpretation begins to solidify. Analysts debate whether the sales represent economic strategy or political signaling. Is China reducing exposure to potential sanctions, diversifying away from dollar dominance, responding to trade tensions? The answers matter less than the perception. Other nations watch. If China can reduce its treasury holdings without triggering a crisis, others might consider similar moves. The dollar's role as the world's reserve currency has never been guaranteed by law, only by trust, liquidity, and the absence of alternatives. And then the numbers began to change. Equity markets, which had initially ignored the bond turbulence, begin to react. Higher borrowing costs reduce corporate profit expectations. Growth forecasts are revised downward. Stock indices slide not in a crash, but in a slow drift. Retirement accounts lose value. A teacher in Oregon checks her 401k and sees a 4% decline. It's not catastrophic. It's not even unusual in a volatile year, but it's real. And when millions of people watch their savings shrink, even modestly, consumption patterns shift. Discretionary spending pulls back. Restaurants see fewer reservations. Retailers see softer sales. By day 50, the Federal Reserve has made its move. Not a dramatic intervention, but a recalibration. The Fed begins purchasing a modest volume of treasuries, signaling support without full-scale quantitative easing. The message is clear: we will not allow disorderly conditions. Yields stabilize, markets breathe. But the Fed's balance sheet has grown again, and the long-term implications of that growth remain unresolved. Every tool used now is a tool unavailable later. The final 10 days proceed without new drama. China completes its sales. $500 billion have been reallocated. The Treasury market has absorbed the shock. Yields have risen, but not spiked. The dollar remains strong. No crisis has occurred. And yet everything is subtly different. The assumption that foreign buyers will always be there, always absorbing new debt as the U.S. government runs deficits, has been tested. It held. But the test revealed limits. Households don't experience this as a single event. There's no day the economy breaks. Instead, a family in Tennessee notices mortgage rates are higher than they hoped. A couple in Arizona sees their investment account down. A graduate in Illinois finds job offers slightly less generous than last year's cohort received. The connections are invisible. The causes are diffuse. But the feeling is shared. Something has shifted, and the shift is not in their favor. The global financial system continues. Treasuries remain the safest asset class. The dollar remains dominant. But the narrative has changed. Other nations, watching China's action, begin quiet discussions about reserve diversification. The share of global central bank reserves held in dollars, which has been declining gradually for years, continues its slow descent. No collapse, no replacement. Just erosion. In the scenario's final days, analysts write retrospectives. Some call it a warning, others call it an overreaction. The truth, as always, sits in the space between. What happened was real. The consequences were manageable, but the precedent has been set. The largest holder of American debt can sell in size over time, and the system will adapt. That adaptability is a strength. It's also a vulnerability. The trading floor is quiet again. Not silent, never silent, but the usual hum has returned. The numbers on the screens have settled into new ranges. Outside, the sky over lower Manhattan holds that same pale winter light. Someone's phone vibrates. This time they pick it up. When systems change this quietly, the question isn't whether you notice. It's whether you understand what it means before the next shift begins. How would you know what it means for you?